Okay, let's unpack this. We are diving into, well, the really high-stakes world of decentralized finance, DeFi.
Right.
Specifically, we're looking at stablecoins.
Yeah.
These are supposed to be the safe part, the bedrock and all the crypto chaos.
Some safe harbor, yeah.
But today, that harbor got hit. I mean, really hit. We're talking about the deUSD stablecoin, how fast it collapsed, and the very serious legal threats flying around now.
It's a pretty dramatic story, and the sources you shared, they really lay out a kind of systemic failure, don't they, involving Elixir, who issued the stablecoin, and Stream Finance, this tokenized yield fund.
Exactly.
So our mission here in this deep dive is to figure out that domino effect. How did something pitched as, low risk, delta neutral?
Which sounds reassuring.
It sounds reassuring. How did that turn into something people are now calling a coordinated fraudulent scheme? It tells us a lot about risk in these synthetic stablecoins.
And just to set the stage, the result was, well, it was catastrophic.
Yeah.
USD went from $1, its peg, down to like 4 cents. That's one of the worst collapses we've seen since, the big one.
Yeah.
Terra Luna. It's a massive hit to confidence.
Definitely. And to really get it, we need to rewind to the start, the trigger. November 3rd, 2025, that's when Stream Finance, remember, they were offering these really high yields.
Cheaping yields, yeah.
Very tempting. They suddenly announced that an external fund manager they used had lost about $93 million of their assets.
$93 million, just...
Gone. Vanished. A huge hole blew up in their balance sheet overnight.
Okay, so $93 million evaporates. What happens next? Chaos.
Pretty much immediate chaos, yeah. Stream Finance slammed the door shut, suspended deposits, suspended withdrawals, standard crisis procedure.
Right.
Now, Elixir, they were deep in this because they'd lent a lot of money to Stream. So initially they tried to sound tough, claiming senior rights, saying they'd get their money back first.
A bit of posturing, maybe?
Maybe. But it didn't matter. The contagion was just too fast. A few days later, Elixir had to do the same thing. Suspend redemptions for their stablecoin, deUSD, and boom, that's when the value just fell off a cliff.
And what's really striking, looking at the sources, is this wasn't happening in a vacuum, right? The whole market was shaky.
Exactly. That's critical. This wasn't just one bad actor, maybe. At the same time, another synthetic stablecoin, USDX from Stable Labs, it also depegged badly, dropped below 60 cents.
And why was that? Same reason.
Similar mechanics, different trigger maybe. Their delta neutral hedges just kind of unraveled, fell apart.
Okay, let's pause there. Delta neutral hedge. Can you break that down simply for us? What does it mean when that fails?
Sure. So delta neutral, it's basically an attempt to create a balanced portfolio. You try to offset your longs and shorts so that theoretically price movements up or down don't really hurt your overall value too much. It's meant to be neutral.
Right, insulated from market swings.
Exactly. But when the hedge unravels, it means the market moved so violently, or maybe the leverage was so high, that the balancing act just completely failed. Your protection disappears.
Got it.
And for USDX, that failure might have been linked to another separate issue, a huge $128 million exploit on Balancer happening around the same time. It just shows this widespread liquidity fragility, as the sources call it. Everything felt brittle.
So a fragile system, and then this Elixir Stream thing blows up. Let's dig into Elixir specifically. They launched deUSD back in August 2025. What was the original promise?
The promise was stability. It was marketed as, a fully decentralized synthetic dollar designed to minimize risk using things like basis trading and delta hedging, those sophisticated low-risk strategies we talked about.
Basis trading. That's like tiny arbitrage plays.
Yeah, essentially profiting from small price differences between related things, trying to keep your overall exposure flat, market neutral. That was the pitch. And crucially, the Elixir team. They were doxxed. Public identities. Supposedly accountable.
Accountable for a safe product.
Okay, but here's where it gets really murky, according to the sources. The big allegation is that Elixir just changed the plan completely in late October.
Right. A unilateral strategy shift. They altered their whole investment approach.
And the killer part. Allegedly, without telling the lenders, the people who put money in, relying on that low-risk promise, they apparently had no idea.
And that change was, well, it wasn't minor. It was huge. Elixir basically stopped doing the complex internal basis trading stuff.
Okay.
And instead, they took a massive chunk of their funds, about $68 million in USDC, just lent it directly to Stream Finance through Morpho, which is a DeFi lending platform.
Just $68 million, just hand it over to one counterparty.
Exactly. And think about what that does to risk.
It concentrates it massively, right? Instead of diversified market neutral stuff, it's suddenly all riding on Stream Finance not blowing up. Precisely. They went from managing market risk, which is complex but understood, to taking on enormous credit risk against one single, ultimately fragile entity. It fundamentally changed deUSD into like a tokenized fund of funds, where Elixir users were unknowingly betting on Stream survival.
And that wasn't disclosed. That shift from market risk to just raw credit risk.
That's at the core of the misrepresentation claim, why they did it. Well, that's probably going to come out in court. But the effect was turning a stablecoin into a high-risk loan portfolio.
Okay, so that leads us to this incestuous loop idea, the structural connection that made the Stream failure so deadly for deUSD. Can you walk us through that?
Absolutely. It wasn't just that Elixir lent money to Stream, the connection was deeper. First, deUSD was somehow structurally tied to Stream Finance's own stablecoin, XUSD. The details are a bit complex, but they were linked.
Okay.
Second, Stream Finance then took the deUSD it got partly from that big loan and used it in something called a looping strategy.
Looping, what does that mean? Borrowing and reborrowing.
Essentially, yes, they deposit deUSD, borrow against it, maybe swap, deposit again, borrow more, amplifying their position within the system.
Okay, wait. So Stream gets the loan from Elixir.
Yeah.
And then uses that same capital, the deUSD, to basically dominate the supply of the very stable coin that lent them the money. That sounds circular.
It is circular.
Yep.
And dangerous. This looping sucked liquidity out of the platforms they were using, like Euler and Morpho, where Elixir was also integrated. It created this huge, concentrated position.
And how concentrated did it get?
This is the staggering part. According to the sources, Stream Finance ended up controlling almost 90% of all the deUSD in circulation, about $75 million worth.
90%. Held by the borrower.
Yes.
That's not decentralization. That's the opposite. That's handing control to one entity.
Exactly. It made the whole system incredibly brittle. The second Stream Finance got into trouble. Remember that $93 million loss? Well, 90% of the supposed backing for deUSD was instantly impaired because the holder was insolvent.
It's like the definition of hidden leverage just waiting to explode.
It really is. And that concentration risk, that's Exhibit A in the legal threats now. It's seen as a fundamental structural flaw, possibly intentional. When Stream failed, the other 10% of deUSD holders had nowhere to go.
Which brings us to the legal fight. K3 Capital is involved.
Yes, K3 Capital. They're a risk management group focused on DeFi, crypto native. They jumped in almost immediately.
And what are they alleging specifically?
They're threatening legal action, and the language is strong. They're calling it a coordinated fraudulent scheme, pointing fingers directly at Elixir's founder, Philip Forte, as the main orchestrator, and alleging Caleb from Stream Finance facilitated it.
Coordinated fraud. That's serious. Are they just making noise or taking actual steps?
Oh, they seem very serious. They've hired a top U.S. lawyer, which isn't cheap. They've already hit Forte with a cease and desist letter, and they're actively putting together a civil complaint to file in court, trying to recover funds for the lenders who got burned.
Trying to claw something back. Meanwhile, the deUSD project itself is done.
Officially done. Finished. On November 8th, just 5 days after Stream's initial bombshell, Elixir announced they were permanently shutting down the deUSD project.
And what about redemptions? Did anyone get their money out at $1?
Well, Elixir claims they processed redemptions for about 80% of the non-Stream holders, that small 10% slice at the full $1.1 rate before everything totally imploded.
But crucially, that excludes the massive 90% chunk held by Stream, which is basically worthless by then.
Exactly. That 90% is the big hole. Right now, everything's frozen. No more issuing deUSD, no more redeeming it. And the team was blunt in their final message. deUSD no longer has any value. Don't buy it.
Wow. Okay, so we've gone from the initial loss, the secret strategy shift, the looping, the collapse, and now legal threats and shutdown. Let's zoom out. What does this mess mean for DeFi overall?
Well, connect the dots, right? This plus the simultaneous USDX depeg. It really hammers home some persistent dangers in DeFi.
Like what?
1, leverage. Hidden leverage, amplified leverage through these complex strategies. It's still a huge risk. 2, stablecoins aren't always stable, especially synthetics or anything relying on rehypothecated collateral. Depeg risk is real.
And 3.
3, liquidity fragility. These synthetic assets, these complex yield strategies, they can evaporate incredibly quickly when a confidence breaks or when underlying platforms wobble. Counterparty risk is everywhere.
So the takeaway for users, for you listening, is basically less trust, especially in these complicated synthetic products.
I think that's unavoidable right now, yeah. This whole incident just shreds confidence in synthetic stablecoins and anything promising super high yields through complex, opaque layers.
People might just run back to the simpler stuff.
That's what the sources suggest, a flight to quality, or at least perceived quality. Things like USDC, USDT stablecoins that are, supposedly fully backed by actual dollars or equivalents, may be regulated. Less reliance on algorithms and complex hedges that can break.
So for you, our listener, the message seems to be, approach any synthetic asset, no matter how clever it sounds, with a lot more caution now. Demand transparency. Demand proof of actual collateral.
Right. Until there's real, verifiable, on-chain proof of reserves and controls that prevent this kind of concentration, this kind of hidden risk, well, systemic risk isn't going away. The market's going to be wary.
It's a really stark example, isn't it? From low-risk yield to alleged fraudulent scheme and total collapse in mere weeks. It shows what can happen when decisions are made behind closed doors, even with a doxed team, in a system sold as decentralized.
And that really leads to the final thought we wanted to leave you with. Think about this. The whole meltdown seems to have started with an internal decision, a strategy change, allegedly coordinated by known individuals.
Right, the doxed team.
Yeah. So how much faith can you really put in decentralization when critical choices like lending $68 million of user money are still made by a small group? Is true code-enforced decentralization, where humans can't just change the rules, the only actual defense against this kind of thing? It's a tough question the DeFi space really needs to grapple with.